I'm on program committee, and this is a offshoot from an event that we started about a year and a half ago, and actually defined contribution as a conversation started from that commentary that we received. I'm going to break from CFA Atlanta tradition a little bit, and to probably what will be applause. We'll be stepping down as far as the moderating role today, and I will introduce Lou Minsky with the Defined Contribution Institutional Investment Association, who is a co-sponsor of this event. But first of all, I'd like to thank, and hopefully our group can also thank, our panelists. And let me just go through alphabetically and welcome Matt Brigham with Genuine Parts, Celina Bordeaux with Pulte Group, Elaine Gaddy with Comcast, and anything that has the Peacock associated with it or Comcast cable is associated with Elaine, and she had the longest trip here from the New Jersey area. Nancy Faulkner with Encompass Health, and Fred Stewart with LCG Associates, representing the consulting view of all things related to defined contribution. How about a short round to thank these for their service? With defined contribution investing, it's really been interesting that as of year-end 2018, the assets in those types of retirement systems have essentially eclipsed defined benefit pension investing as far as size and scope. So this may be one of the first conversations related to the topic, and it certainly won't be the last. With that, I'll get the heck off stage and have Lou Minsky come up and professionally represent the Defined Contribution Institutional Investment Organization and talk a little bit about that.
Appreciate that. Hello, everyone. I'm going to take Joe's lead and generally get out of the way here since we've got this great group of panelists, and I'm sure people mostly want to hear from them. I thought I would just very quickly, for those who are new to TCA, give you a quick overview of the organization, what we're all about, and I think that'll be useful framing for the conversation. So TCA is still a relatively young organization. We were founded, it'll actually be 10 years in January. The organization came out of conversations that I was having 12, 13, 14 years ago with peers in the industry about our collective frustration at the time that people weren't really focused enough on what really mattered. How do we drive better outcomes for plan participants? Ultimately, how do we enhance the retirement security of American workers? And at the time, really, what we saw was a crowding out of that conversation because of what I call the issues of theology, right? My approach is better than your approach. My solution is proprietary. I don't want to talk about it with my competitors. And unfortunately, that mentality was keeping people from focusing on the 90+% we all agree on. And I'm sure ultimately in this conversation today we'll get at a lot of that. But TCA exists really to ultimately bring the community together, to create a community to focus on those things, the things we all agree on, and the things that ultimately will enhance the retirement security of American workers. So hopefully we can get at some of that. Just quickly, so I understand from background, I know this is a group of some people who are deeply involved in the DC space and some people who aren't, but are interested. So who in the room day-to-day focuses primarily on defined contribution issues? I'll include myself in that. So yeah, it's interesting, a little less than half, maybe even a little, maybe closer to a third. Great, well, good. So hopefully this will be useful information for those of you that are deeply involved, and a good foundation and primer for those of you who are more new to it. We'll kind of go through a dialogue with the panelists about things that they're doing in their plans, what they're focused on, what keeps them up at night, broader themes in the industry, but I also want this to be interactive. So as we're talking, if you have comments, you just want to interject, raise your hand, I'll bring you into the conversation. If you have questions, same thing, feel free to raise your hand. If I don't see you, you can even shout it out. But we want to keep this lively and interactive and informative. So let's take it with that in mind. And with that, maybe we'll just start going down the road here. And if you can share a little bit about your programs, what you're focused on with your plans, with your companies, and Fred, maybe at the end you can kind of wrap it up with some thoughts on how that relates to what you're seeing more broadly with your clients. Start that.
Good afternoon. I'm Celina Bordeaux. I am the Senior Benefits Manager with Pulte Group. Pulte Group is the third largest home builder in the United States. We have about 5,500 employees. Within our plan, we have about 8,600 participants, and that consists of active and terminated employees. And we have about 4,600 employees that are actively participating in our program. We've enjoyed around maybe 82% participation levels within our plan. Our average deferral percentage is around 7% among our employees. And what we've decided to do as relates to our 401k plan, we've decided to roll out more of a total wellness program that takes more of a holistic approach as it relates to 4 pillars. And that involves emotional, physical, social, and financial is a huge critical component of that. With that being said, we are in the process of revamping our educational efforts, and we're going to focus a lot on financial education because we understand that financial stressors can become a roadblock for many of our employees participating in the 401k plan, or even better yet, increasing their salary deferrals in the plan. So we're committed to actually rolling out those type of new programs and services that are tailored toward that. And some of them consist of perhaps debt counseling, student debt repayment programs, budgeting, just a great deal of programs centered around financial education.
So as we're going down the line, one of the things I probably should have noted is we've got a great balance here today between people on the HR side within companies, people on the finance side, obviously Fred, working with lots of plan sponsors as a consultant. So I think you'll get a range of perspectives, and we can kind of peel back the onion as we get into the conversation. Go ahead, sorry.
Hi, this is Elaine Gaddy again. At Comcast, NBC, that's the first thing I always like to start with. We are really a series of companies. So there's the Comcast cable side, there's the NBC Universal side. We also have, with the recent acquisition of Sky, we have a much larger presence outside of the U.S. The bulk of our employees are in the U.S., and we do have over 100,000 employees in the U.S., and our plan is quite sizable. As a result, we do have over $10 billion in assets in the retirement plan. Defined contribution, or a 401k plan, is our predominant retirement vehicle for the majority of our employees. We have a master trust arrangement that we utilize to provide retirement benefits for the different groups within the Comcast entities, if you will. We really like auto everything, and by that I mean we do auto-enrollment, we do auto-escalation, so we do try and make it as easy as possible for our participants. Our QDIA, our Qualified Default Investment Alternative, is a target date fund, and we do have quite a sizable amount of money that is in our plan that is in the QDIA.
Hello, everybody. My name is Matt Brigham, the Assistant Treasurer with Genuine Parts Company. It's quite an honor to be here, spend some time with you guys on benefit plans. You know, as Assistant Treasurer, I spend most of my day, running the company's cash and debt, working capital improvement, foreign currency, interest rate, risk management, that types of things. But also, of course, as co-chair of the benefit committee, the pension benefit committee, get to spend a fair amount of my time on our benefit plan. So we have a $2 billion pension plan that we froze back in 2013, and we have an active 401k plan. It's set up as a Pension Protection Act, safe harbor design, so it does have auto-enrollment similar to your plan, auto-escalation. We have a 1-for-1 match on the first 5%. And, so probably have 50,000 or so employees globally. We're actually a global distributor of automotive, industrial, and business products. You probably know our Napa Auto Parts business. But in the U.S., which is what covers our 401k plans, we've got about 27 or 28,000 employees that are eligible to participate. We have a 92% participation rate. The average deferral is a little less than yours. It's 6.4%. And we have about 3.5% of our employees in that auto-enrollment process that opt out of the plan. So we have good participation, and we can get into this in a bit, but I think one of the issues that we have that probably everyone in this room has is just our employees are not prepared, and they're not preparing for retirement. They're not deferring enough income. Average account balances are fairly low. Fred and I were talking last week about those being around 65,000 globally in the United States. Our plan is pretty similar to that. And, so I think, we as businesses and as leaders of our businesses need to do a better job of educating our employees. So that will be a focus for, at least for me personally, is to figure out how we go about getting employees. We provide lots of education, guidance. We provide advice through Elite Financial Advisors, powered by Financial Engines. So we offer managed accounts, but we can't make employees use those services. We can't make them go out and get all the education that we offer them. So I think that's probably what keeps me up is how do we improve our 401k plan to a manner that prepares our employees down the road.
Yeah, I think we'll likely get into some of those conversations. I know Comcast, particularly through NBC Universal, did a lot of work to get people more engaged and, through plan design and default, so we'll probably get into that in a little while. Great.
Good afternoon. My name is Nancy Faulkner. I do work at Encompass Health. I'm the retirement manager. Just heads up, I will be the less talkative one on the panel. I am in the healthcare industry. Our participation rate is about 53% or less. Our industry actually is inpatient rehabilitation, post-acute care. We also have another branch which deals with the home health and hospice side. We do offer a non-qualified plan for our highly competent employees, and we are always looking at ways to bring good options for our participants when it comes to the funds lineup and low cost fees, etc. That's it.
All right. Fred, you want to start pontificating for us?
Not really, Lou, but good afternoon, everyone. Can you hear me okay? Wait till it's done. Fred Stewart, I'm the Defined Contribution Practice Leader for LCG Associates. We are an investment consulting firm based here in Atlanta, Georgia. Been in business for 45 years. We're founded pre-ERISA as a defined benefit consulting shop and have branched out now into DB, DC, as well as endowment and foundation work. Specifically, the number of client assets we work with is over 100 billion in client assets. We specifically work with blue chip clients in the areas of 401k, 403b, 457, non-qualified deferred comps, and all other types of plans. And I know this panel is focused specifically on 401k, more or less, but DC is a much broader topic. And I think the one takeaway that I hear from all the plan sponsors is that since DC is the primary vehicle for retirement, there is more of a focus now on what do we do, how do we help our participants, and whether that's a financial wellness, whether that's a plan design issue, all the way down to the design of the investment menu. All of those things come into play, and it's a much broader discussion simply than we have a retirement plan and set it and forget it. So thank you for having us.
Yeah, to your point about being broader than 401k, I actually earlier this week was at NAGDA, which is the Governmental Defined Contribution Group, at their conference, and obviously in the public sector we're seeing similar shifts to what happened 10, 15, 20 years ago in the private sector, but an increasing focus on defined contribution as, at least if not the primary, an important source of driving retirement security in the public sector, and we're seeing similar trends in nonprofit. Let's shift to conversation about the investment structures, investment process. And Fred, while I'm with you, maybe we'll stick on this conversation for a minute, just on what you've seen over the last several years in the DC industry in terms of macro trends in that area, in terms of investment lineups, investment structures, and then we'll talk to some of the plan sponsors about their philosophy.
Great. Yeah, I would say that having spent my entire career in this industry, we've seen a wholesale shift in terms of what the menus look like. A lot of this has been driven largely by the regulatory and legislative environment, but I would say more importantly on the litigation side. A lot of plan sponsors are frankly terrified of potential lawsuits. All it takes is one call to the Department of Labor, and next thing you know, you have an auditor at your doorstep asking about everything from the investment policy all the way down to meeting minutes. So as a result, the investment menus have become more of a common theme, less is more, and generally fall in kind of three buckets, is like the way we like to describe it. So 3 tiers, 3 buckets. Tier 1 would be target date funds. These are the funds that are utilized for participants who do not make an election. They're the automatic default. They have become very popular, and some surveys from some of the record keepers have had upwards of 70 to 80% of all new deferrals going into target date funds. So the QDIA, or the qualified default alternative, and the target date fund, it's important to get that right, number one, from an investment perspective. I think the prudent way to go about that in selection of target date would be to educate the committee in terms of what the landscape looks like, the degrees of differences between active, passive, or a combination of the two, an off-the-shelf product versus a white label or custom product. That also is an important discussion. So that would be tier 1, the target date alternative. Tier 2 would be a sleeve of passive alternatives, low-cost alternatives. And years ago in the business, you really didn't see a full complement of passive, but you really see that these days. And I think that was largely driven by the driver of going to a low-cost alternative. And then tier 3, or the third bucket, would be active alternatives that complement the rest of the menu. Some plan sponsors actually even take that a step further and have a self-directed brokerage account alternative. Although, holistically in the industry, that's not widely accepted or widely utilized, but that is also another avenue for some plan sponsors to go to. So I think, again, higher level, largely driven by litigation, and the desire for plan sponsors to just have a simple, easy to understand, good performing as well as low-cost investment alternatives for their participants, and then try to help them participate.
Yeah, it's interesting. I think I probably agree that litigation is the biggest driver. I think the other natural driver is just sound behavioral finance and understanding human decision making. So I know I've been in the industry for a little while now. 15, 20 years ago, it was relatively common to see 50, 60 funds in a fund lineup. Some plan I was with would have these mutual fund windows connected to them that in some cases had hundreds of choices. And I don't know how many people here are familiar with the JAM study, which is kind of the iconic study in behavioral finance, but basically the gist of it is, the more choices you have, the less likely somebody is to make a decision. As we kind of, with that context, talk about kind of where you are today and where you're going, your philosophy around investment structures, plan design. Matt, maybe I'll start with you. Thoughts?
Sure. So going back a little bit, we had, when I started 14 years ago at GPC, we had a active pension plan and a less generous 401k plan. We did a soft freeze on our pension plan in 2008, introduced our new PPA Safe Harbor design plan. And then fast forward to 2013, we did a hard freeze of the pension plan so that no one was continuing to accrue benefits. So at that time, we mapped everybody over to this new 401k savings plan. And when we introduced that plan in 2009, we took a hard look at a few things. Speaking of litigation, we said, okay, we really have some investment risk here. We've got over 30% of the assets are in the stable value fund. We've got nearly 20% sitting in the company stock fund. Let's make some changes here and introduce some new funds. Let's introduce a target date fund, which we did. So we don't have a lot of passive options in our 401k plan, but our target date fund is 100% passive. It's done by Vanguard. It's now 32% of the assets, so maybe $625 million of our plan assets are in the Vanguard target date funds. And our GPC stock fund has gone from 17% down to under 4% now. So really made some active steps to make sure that we were not making people sell the stock, but limiting them on their ability to buy additional shares of the stock. That was where our company match had gone for many, many years, was to the GPC stock fund. Now, of course, the match is going where our employees have selected their deferrals to go. So anybody that's auto-enrolled, they're going 100% now. Their deferral plus the company match is going to the target date fund. We don't offer a self-directed brokerage window either. We try to keep our plan pretty simple. Again, communicating to 28,000 employees in the U.S. We have over 2,000 locations in the U.S. for all of our Napa stores, our distribution centers, and that type of thing. I think, so we focused on the investments. The next thing we focused on also at that same time were fees. And there was a lot of articles, and still to this day, articles about plan sponsors getting sued by their employees for having high fees in their plan. So what we did, this started back in 2009, is we went and looked at every single fund that we had, made sure that we discontinued the process of selecting funds that offered any type of revenue share. So if there was sub-TA fees or 12B1 fees, we said, we're going to get rid of those. We're going to move to institutional share classes. We do today still have a few funds, maybe 3 or 4 in our 401k plan, where we do get revenue sharing, but we rebate that back to the participant so that the company is not really getting any benefit from that. It's all going to the plan, and it's going to the participants that are generating that revenue. So I think that's kind of the worries we've had in the past. There's investment risk, then there's the fee risk, and then my fear for the future is just fiduciary risk. What is out there? What's lying out there in the future? Do we have sometime down the road, are we going to have employees saying, you didn't do enough? And again, we partnered with Alight as our record keeper and Alight Financial Advisors as our, to offer managed accounts. And we send every single year to our employees, they get a report card that tells them how they're doing, red light, yellow light, green light, in various categories. Are you saving enough? Are you diversified? What does your account balance look like versus what your peers look like or what your age group should look like? So I think we've done things like that to really, kind of look at it as a way for us to make sure that we're covering ourselves. Hey, we actually have been reaching out to you. We've been trying to educate you, but it's still this notion of, are we doing enough, and did we do enough, I think is my primary concern today.
So for the benefit of some of the people who are less ingrained in the DC space in the room, maybe I'll drill down a little bit. So first of all, you mentioned managed accounts. Can you help people who maybe think of managed accounts in a private wealth setting, which is a little different, understand what a managed account looks
Sure.
like in a DC plan?
And it may be a misnomer, I may have used the incorrect term.
No, use the right term.
Yeah, so what happens in this case is our employee may not be well diversified, and they get a notice that says, hey, you're 56 years old and you're in all equities, maybe you should consider something different. They can reach out to Alight Financial Advisors, who will then, the employee will hire Alight Financial Advisors and give them full discretion to take their assets and move them into the funds that we have available in the plan. And in our plan, again, Fred did a nice job of laying out the 3 tiers. We offer really 2 tiers. We offer the target date funds, and then we offer our actively managed options. So we have 10 active options that run the gamut from a stable value income fund all the way out to global and international. Very simple plan. We created white label fund of funds where each individual option has 2 or 3 active mutual funds that make up that. So it actually makes it pretty easy to plug and play. If we have to terminate a manager, we don't have to notify participants. We can just make a quick change to the record keeper and the trustee, which is Northern Trust for us. But at any rate, Alight Financial Advisor steps in, manages the account fully, makes the investment decisions, and puts them in funds that are maybe more commensurate with their age and kind of what their retirement date looks like.
Yeah, so, and for the benefit of those of you who are less versed in the space, I mean, so the idea basically of a default investment structure came about a little over 10 years ago through legislation. There's a strong safe harbor around it, so almost every defined contribution plan has a default investment. Those that have automatic enrollment, so they're defaulting people into the plan who do nothing, obviously end up with a lot more people who end up in that default investment. Today, the vast majority of default investments are target date funds. Increasingly, there's a trend toward using this managed account solution as the default investment, although many plans have them side by side with a target date as a default, but an optional managed account, which sounds like what you have in your plan. I don't know, Fred, if you see trends toward managed accounts more broadly?
I think generally it's fairly wide adoption for managed accounts in terms of the plans at the plan sponsor level. But to your point, Lou, and also Matt, I think it's low utilization across the participant base. One other thing about managed accounts, it's important to note there are several vendors who provide managed account solutions in the DC space. It's kind of a garbage in, garbage out scenario, so the participants do have the ability to load in additional information. For example, if they have a pension, if they have a spouse, another retirement plan, Social Security, they could put all of that information in, and that model, the managed account model based on the vendor, places a recommended allocation for them to utilize. There is typically a cost affiliated with that, and the participant would bear the brunt of that cost. But I think the larger plans have looked at managed accounts as a QDIA. Once you fall below the $1 billion mark in terms of plan assets, it's less common to have that as a QDIA. It's more common to have the traditional target date.
Yeah, I'd say you see maybe a donut hole where in the middle there is not a lot of utilization because of scale, and then very small plans you see a lot of utilization because they're largely advisor driven, and a lot of advisors have their own managed account that they're utilizing for that, or they're using some kind of a white labeled solution through provider. The other thing I just quickly note for people, just in terms of broad market trends, I think Fred, you're spot on that there's been traditionally a pretty big delta between the advice cost of a managed account and the implicit advice cost that's built into a target date fund. So let's say typical managed account is 35 basis points probably for a big plan, maybe a little higher for a smaller plan. And the implicit advice in a target date fund is 5 basis points roughly, maybe 10, at the high end. So I think what we'll see over time is that delta getting pretty small, maybe even getting close to 0, which will probably drive the product mix quite a bit. The other thing I thought that'd be useful background for folks, you said your default investment has roughly, I think you said 34% of the assets. Do you know what the percentage of the current inflows is?
I don't, I'm sorry.
Yeah, my guess is it's probably
Probably high.
significantly higher, right?
Yeah, much higher.
So one of the things to think about is you think about the investment structures in the DC space is over time, we're gonna see a massive migration to the default investments, whatever they are. So today, target date funds, but there's a lot of back and forth on the provider side of the industry because whoever has shelf space within that default investment, at the end of the day, is gonna have the vast majority of the assets within the DC plans. So, all right, great. So, Elaine, can you share a little bit about your approach and investment philosophy?
Sure. So at Comcast and NBC, we definitely think about, as Len talked about, some of the behavioral finance aspects in thinking about our investment lineup. And what I mean by that is we really try to keep our investment lineup as simple as possible. We really want to, help drive that conversation by keeping the number of options that we offer to our participants as low as possible, but still providing enough choice for them that they can make some decisions around asset allocation. One of the things that we do is we white label our investment options that we offer so that we can further really help the conversation so that we're eliminating some of that water cooler conversation that can occur around mutual fund family names. So we don't have like a PIMCO fund or a Fidelity fund. It's all white labeled. So we have a large cap fund, for example. We have an international equity fund. The underlying investment managers that we have in those white label structures are available. Participants can see that if they would like to see that. That is all available for them on our custom fund fact sheets that we produce each quarter. And that will have all of the details of the holdings on each of these white label funds. Similar to Matt's comments about some of his white label funds, our white label funds are created typically of a number of managers, and we do a lot of structural analysis when we take these different investment managers and blend them together. So we want to look to see how these investment managers will interact over different market cycles and what the tracking error potentially will be, and just in general how these managers will work potentially. So we do spend a lot of time in looking at that. We also look at not only mutual funds, but we look at separate accounts where we can define our own investment guidelines, and we also look at commingled vehicles. We really like to spend a lot of time understanding and controlling the guidelines and really look to understand what other risks might be potentially present that we can control. For example, in some mutual funds, while it might be classified as a U.S. equity fund, there's the potential that that fund could have 20% in international equities. So we always like to be very cognizant of what it is that we are constructing and what we're putting in each one of these investment options that we're offering to our participants. The other thing that I would share with regards to our investment options, when we think about target date funds, we count that as one fund, if you will, when we think of the number of options. But we have 5 actively managed funds, and then we also have 4 passively managed funds. So we try to have an active investment option and a corresponding passively managed investment option so that participants can decide to have both. They can decide that perhaps they want to be an active international equity management, but maybe passively invested in U.S. equities. The other thing that I would share about our lineup is that we also offer investment advice and managed accounts. But our preference, and again, you heard Lou talk about this, is for participants to really invest in target date funds because of the low cost and the embedded asset allocation decisions that are made within a target date fund. When you think about managed accounts, you are paying a fee for someone to manage that asset allocation, and then you are also paying for those fees for each of the investments that are elected. So we always try and balance that out. The other thing that I would also share is we do not have a mutual fund window or a brokerage account. And again, part of that is because of our desire to really help drive that conversation and to really help participants be able to focus on making investment decisions for the long term.
Great. So let me pause for a second. Heard the term white labeling a few times now. Do people generally understand that? Any questions for those that are newer to it? Yeah.
Yeah, I mean, I understand the concept of a white label, how it's made, obviously from a plan sponsorship and management, it makes it easier as far as what you have to notify a client base. But like if I was a participant and I wanted to ask you, what's the benefit to me for having you white label something? Like how would you respond to that?
You want to take a crack at it?
Sure. For us, white labeling is exactly what I was saying before. It's another ability for us to really control the risk of the fund. That is one of the primary reasons. So in a number of mutual funds, you have securities lending. We will tend to avoid mutual funds that have securities lending. That's not to say that we don't have some vehicles that have it, but it's just an example of one of the things that you can potentially seek to control.
Yeah, I don't know, Fred, if you want to make comments more broadly about it, and then I'm happy to share some thoughts as well.
No, I'll just share that it's a tough question for the participants because securities lending is an issue that I'm sure 99.99%
Yeah, it's rare. I would doubt there's a lot of security leaders on in the 401k.
Right. For plan sponsors to do white label, they have fact sheets. The information is available. They have links on the record keepers' websites that take you directly to the information with the underlying alternatives and things of that nature. But I think participant behavior is they really don't ask is the unfortunate scenario.
Yeah, I think so. Think about it this way too. So in terms of from a governance perspective, a typical DC plan, traditional one where you're using mutual funds, you have fund you're not thrilled with, the investment committee, you put it on a watch. All of a sudden now you're worried, okay, what am I going to have to communicate to the participants when I ultimately want to switch out the fund? It becomes as much a communications issue as a governance issue. With a white label fund, you can, you can switch out underlying managers. It doesn't require the same level of ongoing communication with the participants. So, it definitely frees up fiduciary decision-making quite a bit. You also think about from an institutional investing perspective, it gives you flexibility to construct, a broader fund that's made up of, managers that you are identifying because of skill within particular sleeves of the investment. So you're not married to one fund family or, one style within a broader, let's say, large cap fund. And then the third thing I'd say is particularly with plans that have significant scale, there's an opportunity to leverage that scale. So I don't know what the pricing looks like in your white label funds, but my guess is it's quite low compared to typical comparable mutual funds.
And just one quick comment, Lou. I guess around this issue is typically white labeling again is generally done by the larger plans. I will tell you, we will tell you that the trends in the industry overall for the DC space, Lane had mentioned collective trusts and or separate accounts. So anytime there is an opportunity, if a fund fails the IPS and they have a mutual fund in place, we'll look at the appropriate vehicle. And I would tell you that also most, under the billion-dollar space, most plan sponsors are looking at collective trusts and separate accounts as well. And it's largely driven by the fees. And again, back to your question, participants have access to those fact sheets. The performance information's out there, it's updated, and the simple explanations, hopefully better performance, but it comes to fees as well, and that's generally what's driving the trend.
Yeah, and obviously you're seeing fund companies react in creating institutional share classes, R shares, to try to compete. But a lot of the driver is around really, particularly plans with scale, getting to the best institutional pricing that they can. The other thing is you talked about active and passive. Sounds like you basically have mirror white labeled funds. You see a lot of plans using a white label structure to blend, an active and passive approach, deploying active managers where they think they can add value because of, their skill, and in other areas within the same white labeled fund using passive approaches. Great, so let's do a little bit of a pivot. Talk a little bit about engaging the employee population. I know you all talked a little bit about participation in your plans. Let's see, Nancy, maybe we'll start with you. You mentioned, I guess comparatively a slightly lower participation rate. Love to hear a little bit about your thoughts around that, the challenges you face, where you are on the automation scale, and we'll take it from there. How about that?
Well, in regards to enrollment for us, since we are a healthcare industry, we find it very difficult to get people enrolled. Maybe it is because they are hands-on with the patients and they just don't have time once they go home and they're resting for their next shift. One thing that we try to do is we do a lot of communication. We have communication via emails. We actually have an app that we use that is called the Hive. We offer seminars and free webcasts from the fall, well, from the spring into the fall from our record keeper, and they have an opportunity to actually cover a myriad of topics all the way down from creating a budget to getting prepared for estate planning and things of that stuff. However, the participation rate is really low, but I think maybe compared to the industry, we may be partially average for healthcare. We do try to encourage people by just sending out notifications. We do target communications for persons who are not enrolled. Whenever we do offer same-day enrollment, once you become an employee, you're eligible to enroll. You do not have to wait a week to do that, but it is still difficult.
So, yeah, go ahead.
Do you have high turnover, employee turnover?
In healthcare, you do.
Yeah.
You do, and that is, again, one of the struggles.
That would be it right there.
So, any thoughts on auto-enrollment and what
We
the
have
barriers were?
looked at auto-enrollment in the past, and of course, it was a success because it was auto. However, we did find that the cost of that for the company match was excessive,
Yeah.
and we discontinued it.
And-
However, it comes up in all the investment committee meetings. It is something that we continue to discuss, just because we would like to see more people participate.
But the primary barrier just being the cost of the
It
match.
is the match.
Yeah.
What
Okay,
did
good.
it, excuse me, what did it add to the cost?
For the company match, whenever we do auto-enrollment, you are listing someone to auto-enroll at a certain percentage. So whatever that percentage is, if the company is matching that, we automatically match on each payroll deduction. So just the cost of putting people in automatically, the company has to match that.
So it's higher administrative cost.
Not the administrative, the company match to it.
The actual match.
The company
So-
match.
So I will say, I think we had a question here, and then, go ahead.
I was gonna save this question for later, but you started talking about the match. And from my perspective, the whole system falls apart if you don't honor that covenant to match. And I was really wondering about, if you think about the recession and how many times I heard that companies either reduced or eliminated the match at a time when the participants are going to benefit the most from averaging in at lower and lower costs. So to what extent at a governance level or fiduciary level do companies approach that match and budget for it and look forward to actually continuing it in probably the most difficult times?
Well, I will say that during the past most difficult times, Encompass Health never discontinued or lowered their company match. We continued at what we have always set our company match at, so we're pretty proud to be able to say that. I do know too, and Fred could probably speak more on this, a lot of companies are looking at increasing the company match just to possibly engage more participants into 401k, but we find that it's very, very important as a company to offer that match. I mean, it's just an encouragement to be able to have someone say, you put money in, we will give you money on top of that.
Any reactions from the other employers and, or the appreciation internally on the value to the company of the match? I've got some comments, but I'd love to get other thoughts on?
Well, I can tell you at Genuine Parts, our dividend is sacred. And we have in finance, I take probably a controversial stance with respect to 401k match would be, if you take care of your employees, they're obviously going to take care of the business and ultimately our shareholders. So we've taken a stance that it's sacred, the 401k match, that we will not reduce it. In fact, we're looking for ways to increase the match. When we put our plan into place back in 2009, a 1-for-1 match on 5% was probably above market. Now it's likely market. It's, I wouldn't say we're not competitive, but I would say it's not a reason that somebody would come work for us. So I'm looking for ways to maybe increase the match going forward. Maybe it's 1-for-1 on 6 or 1-for-1 on 7, but some higher number. So.
Celina, any thoughts?
No, I just wanted to add to the fact that I would say probably our success rate in terms of having 82% participation, I would contribute that to auto-enrollment. We have an auto-escalation feature. If you're auto-enrolled, you're enrolled at 5%. However, it escalates from 5 to 10% as well. And I'm referencing the point earlier I made as relates to the company focusing on financial wellness. There's a strong conviction to look out for the overall well-being of our employees. So when times get rough, I will say that we have not terminated our match as well. So there's a strong conviction within our organization to look out for the financial well-being of our employees.
So I'll make some broad comments. I think the industry, providers in the industry, particularly HR consultants, have not done a good enough job at helping employers understand the ROI for financial wellness broadly, for the match specifically. So it becomes sort of this game of trying to guess, well, can we pull this lever in the short term when we're, facing difficult financial times? And obviously, corporate America very much is quarter by quarter focused, but I think we have an opportunity for sure to do a better job of linking, workforce planning costs to that match, to broader financial security, trust in senior management, and feelings about the company. I mean, I'm sure some of your firms do employee engagement studies. I've seen hundreds of them, and always somewhere in the top 2 or 3 is trust in senior management is one of the biggest drivers of engagement, which ultimately is a huge driver of employee productivity, and yet we never tie back things like company generosity or going back on that to those engagement levels. So anyway, I'm on my soapbox.
I have a question. It could be any of y'all. There's on the right side, you got 4 different industries, and I'm kind of in the business of DC. I'd like to ask a question. When you make your match or your overall plan, do you benchmark yourself against your peers or your competitors? I know some of you might have more labor-specific geographically, like Penn State Celina, but a builder, as opposed to others might be industry-related. But do you benchmark yourself against your competitors and how you're doing the match?
Yeah, we do at Genuine Parts Company. We work with Willis Towers Watson as well as Alight, our record keeper, to look at how we look versus other retailers, but also versus our peer group, as defined in our proxy statement. Would be AutoZone and a number of other businesses. We're looking at what we look like versus them. And I just back of the envelope, to increase our match 1%, if we went 1-for-1 on 6. It would be $13 million increase in our expense. So it's great for me to walk down to our CFO's office and say, hey, let's do this. And then it's, well, what are you going to do? How are you going to make that up, Matt? So it's a difficult conversation. We're all, and I've heard one of my former bosses say, we're all dialing for dollars, and we do that in our respective departments at GPC, is we're all looking for ways to improve the business, but also reward our employees.
So can I, just as you're talking about the benchmarking against peers, I'd also be interested if you benchmark against outcomes. So, how are you doing compared to a goal of replacing a certain amount of income or getting to a multiple of final average pay or something like that? Anybody doing it right now?
We spend a lot of time just looking at participation across all of the different groups that we have. I mean, one of the challenges that we have on the NBC side is we have people that will come and work on a show. And that show might film for 2 months out of the year, but they come back every year to do that filming. We want even those people that are, with us for 2 months out of the year to participate in our plan. So we do try to design our plan so that that they can participate in the plan. So we really are focusing on participation rates and looking to see whether we have employees that are eligible.
So just I guess a kind of a quick distinction, right? So this whole idea about reducing the match, that's more, I think, prevalent, right, in a small plan market where you're talking about discretionary match, as opposed to large plans that are under safe harbor rules and have safe harbor matching.
Well, let's be clear. So there are some large plans that follow a safe harbor formula. The vast majority don't. And I would say in the GFC, you saw some very, very prominent large companies at least temporarily suspend the match. So it's not unprecedented to see it. I think most of the companies that did caught some pretty bad press for it and may not do it next time around, but it's happened.
If you do that, if you were a safe harbor plan and you cut the match, I guess would you then be subject to discrimination testing?
So you could pull the trigger even if you were safe harbor, you just wouldn't get the benefit of the safe harbor. And as you probably know, most plans that follow a safe harbor formula would have no problem with testing anyway. Is there a question in the back?
Yeah, my question is for the HR person from Compass. Did you try to stretch your match at all?
Try to increase it.
Stretch. So,
Stretch your match.
and maybe let me frame that a little bit. So, one of the conversations you see a lot with companies that are worried about the cost of auto-enrollment is, hey, maybe we can backload the match a little bit. So instead of matching dollar for dollar in the first 3, we'll spread it out and do 50 cents on the first 6 or 25 on the first 3 and then really backload it as a way to say, well, we're going to auto-enroll you and take on a limited additional employer cost, but if you want to reach for the full match, you've got to save some more.
We have not, but we are looking at ways to do more with the company match.
That'll drive better outcomes for your employees.
Yeah, and I agree. And I think even short of companies that are worried about the match cost, just sending the message to employees, yeah, you need to save more ultimately to get to the right retirement security goal. So instead of sending a message that 3 or 6 even is the right place to stop, by spreading it out much further, you're sending them that message. Yeah, maybe you should shoot to save 10 or 15 or whatever.
Could you also improve employee retention?
I think with your medical bill, it's kind of like retail. If there's 50 cents increase somewhere, they're probably going to go for that 50 cents. So, probably not.
I mean, this is one of the tools to reduce turnover.
It's an interesting dilemma. I mean, I will say that you asked about benchmarking within industry. I think one thing that's underappreciated in a lot of these companies, there are segments of the workforce that's not industry specific. Jason and I used to work together at a large energy company. Well, I mean, there was a big segment that was call center workers, right? Your call center worker isn't leaving to go to another utility. They're going to work at Walmart. Or somewhere else around the corner where they might get 50 cents more an hour. I've always thought that there's an opportunity when you get that person starting to build up a little bit of financial security to bend that curve, to say, well, maybe that 50 cents isn't worth it. Maybe I'm getting more than that by staying here.
Can I ask you a question that the sir in the back that just asked the question on the stretch? Have y'all done that at your business? So I think that's a great idea. I hate the idea.
The answer is yes. And I'm a record keeper, so we manage many different plans. So.
Yeah, I hate the idea that the message we've sent is 1 for 1 on 5. The employee may think, okay, that's enough. If I do 1 for 1 on 5, I'll get the 5, I'm saving 10%.
Usually they stop.
Yeah, exactly. We have 25% that are stuck at the 3% deferral rate. We've got 25% that are stuck at the 5% match. But if we could do something like, hey, we'll do 60 cents on 10%, now you're getting 6% match versus the 5%. Just things like that are, I think, good ideas.
Right.
Okay.
I think, did not NBC Universal do something like that in the past?
No, we do dollar for dollar.
Okay. Yeah, it's definitely something you've seen some movement toward. And it definitely sends the message. Wherever you stop the match, you're sending a message that's the right place to anchor to. You're sending the same message, by the way, with wherever your auto-enrollment rate is, and if you escalate, wherever you stop the escalation. So at least being mindful that how you set those design elements actually makes a big difference. Any other questions before we, yep?
Yeah, so this is for Nancy. You had mentioned you got 53% participation rate, and you got a non-qual plan for your highly comp. So I'm assuming you set that up because you're having trouble passing your compliance testing for the plan. Is that right?
We usually fail our testing. And yes, we did. And also to give them another vehicle of savings for the highly comped employees.
Yeah, I mean, at some point, it'd be interesting to see if you could tie that conversation around that match cost to the cost of maintaining that non-qualified plan and say, maybe at some point we could get rid of that plan if we could design a program that everybody could maximize the qualified. Go ahead.
Not to throw water on this conversation.
Yeah, let's go for it.
I think it's a completely different kind of mindset thing going on here.
Yeah.
When we were talking about an industry that has very high turnover, you're kind of, banging your head against the wall, talking about stretching and all this other stuff. And we're probably talking about not very high income individuals, folks who are looking for the next dollar, who probably, and I don't know what the average employment or tenure is, but let's say it's, 3 years or less. You're not going to go sign up for some plan, and you're going to be out of there in the next 36 months. So you can communicate all you want, you can stretch and match all you want. I think for some industries, it's very difficult to kind of fit in.
You're absolutely right.
I hear you, and I agree. I will say that I know some companies in the industry that are doing it today and doing it to some success. So I would say it's definitely challenging. And it's a difficult internal conversation with the C-suite because they have to trust you that you're going to show long-term ROI. But let's talk offline. I can give you the name of a couple companies you might want to talk to. Was there another question here?
No, I was just going to echo the same sentiments that he had. It really comes down to the participant demographic, and what we're talking about is not about trying to calibrate what's the right amount of match, because that means nothing to them whatsoever. And you really have to get down to the educational component at some point, because that's what's going to really move the needle.
Yeah, and the other thing that I would add with that too, that, one of the challenges, if you have people that are there for a very short period of time and they don't understand the benefits of your plan, if they leave and they then take their money out of the plan and don't understand that there's going to be 15% withholding out of that plan, you've now even put them in a worse position. When it comes
the ones who were auto-enrolled, and they don't even know that they had money coming out. They've now left the building, and the money is sitting there.
Yeah, so as an example, one of the companies, which I'll happily share with you offline, in the healthcare industry, I know was one of the first companies to explore opportunities around automating the roll-in process as a way to combat that and to build a relationship with these employees that they felt like, okay, I've got this new employer who's helping me consolidate all these old accounts there, and all of a sudden, okay, now I've got a relationship with this company that's less transactional, and it's worked for them. So, I think there's a need to be creative, and there are a lot of challenges, but opportunities. Go ahead.
I look at some of this a little bit differently because it seems like a lot of employers look at matches and so forth as a cost. And I sort of view it that there's a total cost that there is to employ somebody, and and I can pay it to them in various forms. I can pay them in cash or through the 401k or other benefits. And if the person who will take the job that has the most cash is probably a less, call it squared away individual in general than somebody who goes, well, it's the same dollars, but I get a deal in the 401k. So depending on the industry who you're trying to hire, I look at a good amount of match as a good hiring screen, because the people who are trying to maximize their paycheck, who I might not want, right, will go somewhere else. But the people who are long-term thinkers, who I may want, are more attracted to the benefit package I put together.
Yeah, I don't know if any of you have done it, maybe the HR people are more familiar, but a lot of companies do conjoint analysis, right? And they look at it in different lenses. So you're right, I mean, there's definitely a screen you can look at for hiring, but there's also, you know, a very different impact on retention and engagement. So you see very different ROI scores on different components of that employee value proposition. But typically, once you have them in the door, you get a lot greater return on some of the other things other than cash compensation. Do any of you do conjoint internally? No? Any other questions before we move on? All right, great. So let's talk a little bit about the other end of the spectrum, which is decumulation or lifetime income. It's an area where I'd say, to be fair, we've seen less activity than maybe the industry has wanted and hoped for. Where are all of your heads at in terms of helping your plan participants think about the decumulation phase after they leave you, and what you make available within the plan, or what you think ultimately you're going to leave them to? And maybe we'll also use that question as a way to talk a little bit about the legal and regulatory situation and fears around litigation. So anybody want to raise their hand and jump in? Otherwise, Matt, maybe you're looking at me, I'll start with you.
So we have not, we haven't looked at this retirement income option. We've kind of talked about it. I know there's some legislation that may have passed the Senate or the House and kind of waiting on it to get through. We'll see how that turns out, but I can tell you that the primary concern, again, I mentioned earlier, Fred and I talked about it, is this notion that the average balance is $65,000. I did some additional work over the weekend, saw that for those that are in their 60s, the average balance is $200,000, which means if you believe in a 4% spend policy, you've got about $8,000 a year to live on, or $666 a month, something like that. And, you know, I feel for people that are my generation or younger that aren't going to have a benefit plan, a pension plan to survive on. They'll likely have their 401k plan, and they'll have maybe Social Security. Don't know if we should count on that or not. I hear one day yes, one day no. But you know, I think that 4% spending policy, you know, is not the same for everybody. But I think we as plan sponsors and as employers need to spend more time. We do financial wellness, we do education, we try to lead our employees to that information, but we can't make them read it, we can't make them look at it. So my short answer is no, that we haven't spent a lot of time on looking for some sort of annuity product that we can offer, but hopefully in the future we'll look at that as something to offer.
All right, great. Elaine, you have any thoughts? And maybe I'll share a couple after that, and then we can go to the audience.
So when I think about retirement income, I think about the whole spectrum of solutions that are available. So that could be something as simple as offering an annuity window outside of the plan, also looking at potentially payout strategies where you're just you're not introducing any annuities or anything, you know, similar to that. I'm also thinking about things like offered through financial engines with Income Plus. So there are lots of different products that are out there. I think it seems like maybe monthly now, at least, I get a call about a new interesting product that is coming out, or that is under development and is awaiting funding, and it's very interesting to look at the different designs, you know, and as I was just sharing, these designs can really run the gambit in terms of, you know, what their goal is in terms of helping your employees. So for at Comcast, what we have done and have had on board for a while is we introduced the Income Plus solution within Financial Engines. That's our managed account provider. And that is really what we've done to date. We are always looking and listening when investment managers and consultants come to the market with new products and solutions. And that is truly what we are doing today, is looking at a number of these solutions and products that are available.
Great. So I'll do a quick commercial. So we actually are about to release a series of papers around this topic. There's been a building conversation in the industry about shifting away from the silver bullet mindset, that there's not going to be one single solution that's useful for all participants, or frankly appropriate for any one fiduciary to put out as the solution for everybody. So we've tried to start an internal conversation around a concept that we're calling retirement tier. So getting back to the earlier conversation about the tiers within the plans, thinking about retirement and decumulation just like accumulation, that, you know, you might want to think about, you know, different insured and uninsured options, advice, and product all together holistically. So look for that. It's coming out soon from TCA. I see we're getting a little bit tight on time, and we promised a hard stop at 1. I'm going to pause here, see if there are questions around this or anything else. If you have questions about public policy, what's going on in Washington, happy to answer them. And after we break, I think, you know, people will stick around if you want to have conversations. We'd love to help facilitate them. Go ahead.
From a cost and expense standpoint, since you all are large plans, from the administrative cost of the record keeping fee, the assumption there would be that the employer covers the cost of the record keeping fee, and then from the investment fund standpoint, that there's limited to no revenue sharing in terms of the funds or share classes that you offer to your participants.
So maybe let's go down the list, and we can go, and then I can tell you that one of those assumptions is not market correct, but go ahead. I'll tell you what.
For us, yes.
Yeah, we use actually forfeitures for the plan to cover plan expenses. So we have pretty substantial forfeitures in our plan.
We charge our participants a flat per person record-keeping fee that comes out of their account on a quarterly basis. All the investment manager fees are charged back to each of the respective investment options.
And we absorb the record-keeping fees for our employees as well.
So I think what you heard here is pretty market representative. The vast majority of large plans have the participants absorb the record-keeping fee in some way, either through a flat dollar charge. Some, even though they have gotten rid of revenue sharing, will build like a 1 basis point wrap around the investments. But there are very few. We have one here that where the company absorbs it directly. Fred, is that consistent with your client base? Okay. Any other questions? Go ahead.
During spikes in market volatility or crashes, how do you keep your participants from running for the door?
It's funny, we don't have a problem, honestly. I mean, it's amazing. I never hear from employees on market fluctuations. I never hear from them on, hey, I'd like to have an emerging market equity fund or a ESG fund or Bitcoin. Nothing.
So I can tell you that
just don't hear from them.
that there are spikes after every market event, but the spikes are from almost 0 to 1 to 2%. So people make assumptions about you know, the level of engagement plan participants have, and I think you're almost always safe to assume that the biggest driver is inertia and lack of engagement and activity. So even the biggest spike days, which are 200 to 300% of normal volume, you're talking about minuscule numbers.
are in the midst of a huge recession, how do we ethically feel about encouraging people to have 8% equity?
So let me, Fred, you probably have clients on both sides, so let me just, before you answer, make one, contrary argument, which is you would hear some investment specialists, economists say that actually we have the opposite issue going on in the DB world right now, which is you have people leaving the equity premium on the table, largely moving to LDI strategies because of a fear of volatility and a lack of willingness to take risk on their balance sheet. And yet, you're talking about vast sums of money, and it has a negative impact on our economy. So, but with that, I'd let you take the question.
Yeah, so,
and I want to reframe. I don't disagree with anything you just said, but it just seems very unbalanced that all the risk is on the individual side and there's a de minimis level of risk on the corporate side. Something's wrong there.
you're right. I would say back to the gentleman's question here about the participants, just keep them off Twitter and we'll be okay, all right, so for the spikes in volatility. But in regards to that comment, I think it's interesting to see with target dates being the largest utilization of any of the alternatives in the lineup, it doesn't change your question, but I think it's caused a little bit of a different focus on target date funds. So back in the financial crisis, the DOL became very interested in target date funds because you had some of the target date funds that were out there. In 2008, a 2010 fund, some of those funds had 60+% allocation to equities. And for a participant who's getting ready to retire in 2 years, they lost, the worst performing target date lost 42%. They're never getting that back. So the DOL got involved, a lot of the target date managers got involved to not only help educate the participants even better than they had before. That led to a proliferation of additional target date funds. At one point, there were 73 different target date fund families, and they were all different. But I would tell you that the market has actually driven a lot of the changes in the target date industry now to where we are, and the proprietary target date managers, the proprietary to your record keeper, are becoming less and less common these days versus a non-proprietary alternative that have done hopefully better jobs with their glide path, their asset allocation, the fees, et cetera. So I think the market, I wouldn't say self-corrected. They haven't solved for the issue. It's still there, but it's better than it was.
Yeah, go ahead, and then I think we're going to wrap soon.
So I guess I fall in between there. So to an extent, I feel, and you can correct me if I'm wrong, to an extent I feel that you're right, because if you go all the way back, by default, most people were risk averse, so you have huge balances and stable value.
Yeah, still do.
And so then all of a sudden now we're like, that's not going to get you to the end, staying in stable value at 3%, whatever it was back in the day. So now all of a sudden you expand the investment lineup, and investment lineup is a hell of a ton more equity heavy than it is fixed income heavy. So then yes, you did start to see the risk, but the advent now, right, of target date funds with this automatic glide path down becomes now offsets that, I think. So to an extent you're right, but I think with target dates coming into play, that kind of changes.
Yeah, and I think we talked about the retirement here, but part of that you're seeing plans, managers start looking at are there ways to build in hedging into that glide path? So dollar cost averaging into lifetime income protection as people get over a certain age is starting to be part of the conversation. So I think we're going to see that conversation continue to evolve. With that, I think hopefully everybody can stick around afterwards. We'll have conversations, but thank you all very much, and please join me in thanking the panel.